Well, good afternoon, everyone. My name is Eric Anderson. I'm the Chief Technology Officer at SynMax, joined today by Bill Perkins. And Bill, I'll let you do your own introduction.
I'm Bill Perkins. I think they call me the CIO of Skylar Capital. I guess that means I started it. We have a hedge fund. We do things.
Also the President of SynMax, President of SkyFi, Chief Wakeboarding Officer, author.
Excellent robot dancer.
Excellent robot dancer.
Retired champion.
Professional poker player.
No, amateur.
Amateur poker player.
Fish poker player.
Very good.
There you go.
Bill, I want to start off with kind of a general question. Obviously, a lot of people know you because of your great success in natural gas trading. What would you say is the purpose of trading? Why do we need traders in the world?
Why we need traders? Why does society need traders? I think
Exactly.
society needs people to warehouse risk. And so I think the fundamental traders, the risk warehouse shops, we're essentially glorified insurance agents. You produce a commodity. It produces this commodity ratably over time. The market isn't there. There's no sales aren't lined up exactly when your production is there. You need somebody to warehouse the risk. In order for you to finance that well or that cornfield or that whatever crop it is, somebody's going to warehouse the risk as a buyer. Consequently, on the other side of that, there are people who are dependent on that commodity, whose businesses would go out of, who would go bankrupt or be harmed financially if that commodity skyrocketed in price, and they look to someone to hedge their risk from price rising. And so we kind of sit in the middle with our models and our analytics and tracking the weather or whatever as we track to come up with a price and warehouse a risk on where we think fair value is, and then we will put on trade. We will be induced to put on trades or not based on the price. Okay. And so that's why society needs us, right? Like if you want to have corn production or crop production or oil production or et cetera, somebody's got to take the price risk at the end of the curve. Sometimes that's investors like ExxonMobil. They don't hedge that much. They're just like, hey, we're just wherever it goes, it goes. And mainly for the independents and smaller producers, it's like, no, we need these cash flows locked in, or else the bank is not going to find us, which means we can't buy the equipment, which means we can't drill the well.
Gotcha. Okay, so taking it kind of through a micro example, if you're a small independent natural gas producer and you have a field that you want to develop and it's going to take 10 years to develop that field, one of the options available to you is natural gas futures, where you can sell your production for your planned production in advance, lock that price in, reduce your risk profile, right? So then you have better access to capital.
Correct.
And you have more stable returns. But the problem is, who's going to be the other person on the end of that trade, right? When they go out and sell production? Because we obviously have a use case where people are buying natural gas closer to the prompt, but somebody needs to warehouse the risk and ferry that contract from the producer all the way to the immediate consumer.
Yeah,
is that right?
think for most of my trading life, my job has been to warehouse a short in the front from inflation hedgers and people who were worried about running out of gas in the winter. And locking in prices, and being long ratably contracts in the back, right? I think that was a structure of the market, right? People, a large long in the front, and this kind of like ratable short from the producers producing the commodity throughout time, and that was kind of like the structure. I was paid to do that, find a level in which I would put that risk on.
So does that mean in the aggregate then that most natural gas traders are net long the commodity if they're buying it in the back and they're selling it in the front? Or is there just too many other factors that kind of...
it doesn't necessarily just come like Pioneer isn't calling me up, right? Like they're doing some sort of volume production payment. They're doing it with a bank. Bank puts it on their books. They take off, they have some sort of asset lending or drilling lending program in which, you got to hedge 50% of your production or X% of your production, or else, the banking side is like, we're not going to give you this money, right? And so they hedge with their commodity desk. Commodity desk puts it on. They have their regs, and then they just dump the futures into the market, right? And they have this big credit risk and some price risk, right? And then the rest of us insurance agents out there, the smaller hedge funds, the larger hedge funds, et cetera, we wind up with the tail end of it. And so if you look at people put out reports of what the hedge ratios are of producers, it's millions of lots sold, right? And so somewhere in the banking, hedge fund, warehousing business, we're net long, right?
Yeah.
Ratably out the curve. And certain events will offset that. You may get some LNG buyers out there buying, locking in their arbitrage now. You may have some power plants out there as buyers, but in generally, it's net sellers over for contracts.
Okay, that makes sense. So if I'm understanding this correctly, basically there's a bunch of physical participants in the market who have a reason why they want to buy or sell gas. But the problem is that they're not always in alignment with each other just to be able to trade directly with each other. So you need someone in the middle who can assess the risk of it, right, and vary the contracts between the different market participants.
Right. Like so most of our trading, at least my trading, I think a lot of fundamental traders are kind of like terminal value traders. Like we're like, where will this contract end? Right? In between, the supply and demand of futures contracts, the needs for hedging is largely driving price movements, right? And of course, some of our analysis of what the new fair value of the contract is. But at the end of the day, a willing buyer and a willing seller have to meet to buy it, and we're kind of like figuring out what that price should be based on our forward forecast of supply and demand. At least that's what I'm doing, and I think a lot of people are doing that.
Gotcha. And of course, you don't have perfect information. Nobody has perfect
Correct.
information. So you're taking an enormous amount of risk. What are your thoughts on risk taking in general, that being the business you're in?
I think we're in a risky commodity because it's highly sensitive to weather, which is unpredictable. And so a lot of people's models are based on weather normal or 10-year weather normal. This is what I think, but if the weather does X, Y, and Z. And then there's the understanding the fundamentals of every aspect of supply and demand. One is, what is production now? Trying to measure it, right? And there's a measurement problem in natural gas. It's not as transparent in Europe, right, of what's going on with supply and LNG regas. So we're tracking, current production, what is it? And then what is future production going to be? And that's tracking, used to be rigs, then it's frac crews. Now it's frac crews and details, right? Because now there's this game of once the well is fracked, we're not going to just turn it on and as fast as we can. We're going to delay it and try and play the futures curve. And so I think producers, at least two of the larger producers and some of the smaller ones, have become traders in themselves, taking advantage of the curve. Whereas before it was like, hey, I'm in the manufacturing business. My job is just to manufacture as much as I can below the current, below price, as cheap as I can, and let the futures guys trade as much as I can, trade as much or warehouse the risk or do what they want. Now they're looking at the shape of the curve, what interest rates are, what their balance sheet is, what kind of capital they have, and making decisions based on that, which kind of quasi makes them traders. And so there's like another variable that we have to be aware of, and we're using all the tools we possibly can to track that behavior and understand that behavior.
Gotcha. So, I mean, your business, right, is to know as much as you possibly can about all the components of supply and demand so you can appropriately price this commodity and warehouse that risk for people. But there is some amount of uncertainty in it.
Yeah.
In some cases, a really large amount of uncertainty. It's somewhat easy to measure reward or potential reward, right? You can just do the math. But risk has been something that's really hard to quantify. So, I don't know, do you attempt to quantify risk, or how do you conceptualize risk? Like, if there are certain error bounds around certain components of your S&D, right? You have this much of an error band or this much of a qualitative risk around supply. There could be a hurricane, there could be a freeze, there could be all these things, right? I mean, this is a really big question. It's probably a bigger discussion, but how do you take all of these uncertainties and bring that down to just, a number of decisions that you make as a trader?
Yeah, I think, well, the first thing we do is try and get the fundamentals right. I started way, way, way long ago back in the Centaurus days, like on the trading floor, and analysts like, why are we guessing when we can know? And so we would build tools, send people out on helicopters, like whatever it took to like try and get information, because I look at traders as essentially value add on top of information and analysis. And so one is like getting the data, and two is properly analyzing the data. And so the more data that we had properly analyzed, the easier my job was to provide value on top of an analytics or analysis of the situation. Despite that, you look at like, okay, what, we're constantly, what is the resolution of our knowledge? What is the resolution of our model, right? Like, are we going to be within a half a B, et cetera? And so depending on who you are and what the resolution of your model, that's kind of like your error band or your standard error band, right? And so then you have these scenarios of like, okay, we think we're good. Let's say we're half a B. We think our model is going to be in a half a B if the weather is exactly as we say, normal. God says the weather's going to be this. Then it's like, okay, we kind of simulate that for the biggest variable that's moving, weather.
Yeah.
And weather, it used to just be temps, and now it's wind. So weather and wind, right? And then you're like, well, what if this happens? What if, this? So there's a lot of what if scenario analysis.
What if a pipeline blows up?
Yeah, well, that one we didn't Monte Carlo the pipeline blowing up, yeah. Freeport blowing up. We didn't model that one. We got hurt pretty bad on that one. But we do look at these scenarios, and then since our market is we don't have enough gas or cushion with just production alone for the winter. We have to store gas. We have the situation where we generally are trying to fill to the tops to get through the winter, which means we can overshoot and get into or pointing at overshooting, and which we can get into what's called a containment scenario where prices have to drop rapidly to induce demand or have producers shut it in. Or we might not have enough gas where prices rally and we kind of destroy demand so that we can actually get to a level, et cetera, or prices in the winter have to be very high in order to have more coal burn than gas gen, and some industrial stuff behind the meter stuff that there's some switching, maybe some ethane rejection into the pipe, et cetera. Those things that increase apparent supply, and so with that error band, if you're like, oh, if I have we start the season, we say, oh, I'm pointing at 4,400, right? So I'm like, wow, I can be off 2 BCF a day, and I think prices still have to be within this range. And then you can have, and those are the great scenarios for traders. These scenarios where it's like country time, where it's like we're pointing at containment. Doesn't matter what's going to happen.
Yeah, it's very
at the end of the day, one way or
wrong.
another, price is going to have to go lower to induce demand, et cetera. And then there's these scenarios where it's like we're pointing at 3,900 or 3,950,
Just on the edge of
just on the
containment.
edge, like what's going on.
So you get a real bifurcated outcome,
Yeah.
right? Where if you get it just a tiny bit wrong on one side or the other, it's going to swing price huge.
Right, and you kind of look at the curve, where the spreads are, what would happen, and like kind of do your what if analysis to get your range. Like, what if I'm wrong? I realize though, some of the biggest smashings I've ever had in trading, because all traders get punched in the face, is not is getting that what if I'm wrong price move incorrectly. Like, it's always been a little bit larger than I've previously expected. And now, one of the things is that liquidity, particularly when the fundamental shops all kind of have the same view, right? We're all the shops are pretty intelligent, right? They're good guys. They've been doing this for a while. A lot of us are dinosaurs. We're not competing against each other. We're insurance agents. We're like, yeah, that's a good insurance policy to write. That's a great insurance. Everybody's like, that's a great insurance policy to write. And then something goes wrong, and we're all trying to get out, and we need help from it has to go to a price, not only for the fundamentals to like balance, but for us to take off our risk because we're outside our risk limits, et cetera. And so I think most of the errors that I've had historically is a lack of understanding of how the liquidity appears and disappears.
That's one of the big challenges to risk. So my old job was actually calculating some of these risk metrics.
Right.
The one that I think is the market standard, which I want to get your thoughts on, is VAR, value at risk.
Yeah.
Right. And the problem with VAR is it's great when things are going well, and it suddenly breaks when things are going bad. Right. So it relies on the volatility of the market and the interplay between the different contracts to produce a total volatility that you can measure and predict. But then you get a liquidity event like you were talking about, right? And VAR just completely breaks down. So it's almost like it's a lagging as opposed to a leading indicator, making it
that's one of the biggest
useless.
problems with VAR is it's backwards looking. It's not looking forward to what the scenario is, what are the positions of the market, like what can happen, and et cetera. So I mean, it's a tool. We got to have something, So and banks, risk management, investors, everybody loves that one, and everybody kind of like uses that kind of like as a standard thing. But like when, the volatility tends to change, and it's not based on the volatility from 10, 30, 90, 180 days ago. And certain products are not heavily traded, not that much history, that, some infrastructure is about to go in, and it's going to completely change the volatility of that scenario, right? And so basis locations, et cetera. So I think as a trader, at least a manager of traders, particularly, you have to understand like, whoa. Irrespective of what your VAR says, you can't have these many contracts on, right? Or irrespective of this, like, hey, I've been there, I've lived through it. Like, I know your model says that thing's worth a tick. It's probably worth a penny or 2 pennies based on like the way things can get out of hand in that instrument or that spread or this current upcoming scenario. And I think that's some wisdom that traders acquire over the years. And, you know, that keeps them alive.
Yeah. So there's the benefit of experience that comes from just, I've been there, I've seen these liquidity events, right? You know, I know what can potentially go wrong because I've lived through it. But you know, it sounds like one of the things you're saying is a lot of risk management is actually about understanding the fundamentals. Like the two go hand in hand. So it's not just calculating VAR. Or it's not just, you know, I'm going to have this position limit or something. It's, you know, I understand per BCF per day what each component of my model could do in either direction and how that would influence my position.
Right.
Is that fair to say?
Yeah, is that going to put me in a chaotic situation in the market, in a chaotic situation or a panic situation, et cetera? You know, kind of like the caveman swag people got the housing crisis better, right? Better than all the quants in the world at the banks, because they had these models that told them that housing never goes 20% down in a year. Like it just can't happen, right? And
because they'd never seen it before.
And the cavemen were like, that doesn't make any sense. Housing prices have just doubled in this region. Of course they can go down 20%, right? Yeah. And so like they would get in front of Congress and be like, yeah, our model said this. And I'm just like, that's the dumbest thing I've ever heard of, right? Like just straight common sense tells you something that's gone up 100% could go down 20% or 50%, right? In a year. And so I think, you know, over-reliance on technical things and being very myopic can get some of the younger traders, some very bright people in trouble, not going like, wait, let's take a step back here. You know, this is the fundamental scenario, and yes, if it goes this way, the price should have to go here, the balance, but there, you know, the entire insurance market is short this product, right?
Yeah.
Who are we going to get out from, you know? Who's going to come in and, you know, we're going to have to go to a different price that makes it ridiculous for there to be new insurance agents, generally global macro strat, right? Guys have billions and billions of dollars trading everything going, oh, that's interesting. I'll sell that, or, oh, I'll buy that.
Yeah. Yeah, these models can be, sorry about the background noise.
Yeah, that's all right.
These models can be really informative and they can be really enlightening and they can help people find new trading opportunities, but it sounds like they can also put blinders on. Right?
Yeah, you don't want to become over-reliant on, well, I'm safe because my VAR says X, Y, and Z, right? Like VAR changes over time, it's backwards looking, et cetera. And I think, you know, most of the traders watching this like, yeah, I get it, move on to the next subject, right? Like it's like, we get it. We have to be forward-looking, not backwards-looking, and that's also with respect to risk. And so that's one of the biggest problems with VAR.
Gotcha. So you're a fundamental trader. You've always been a fundamental trader. I want to ask about other trading styles a little bit later, but I also want to ask you, you know, do you always have a position on? Is there always opportunity you see in the market? Or are there ever times when you look at it and you feel like things are balanced and you're like, you know what, I'm not going to put anything on right now? And how do you decide when that is?
Yeah, I think, you know, risk selection usually have a smaller position, right? Like using like kind of like a Kelly criterion type mindset, right? I think every trader has that, is that the size of your position is commensurate with the edge that you believe that you have. And so when they're in these scenarios where you're kind of like, I think it's like 52-48, you usually have nothing on, or you're waiting, or you're looking at other things for something to develop, because the weather, the wind, infrastructure, things coming on, things not coming on time will create opportunities. And so I think one of the problems with traders, well, how about this? I won't say traders. One of the problems with me is I'm impatient, right? Like I'm like, oh my gosh, we're never going to make any money again. You know, it's like, where's the opportunity going to come? And sure enough, something will happen, right? It'll be a warm winter, or infrastructure delay, or something blowing up, or something happening, a new phenomena that will create distortions in the curve or an opportunity for us to get it, to put on trades. My job is to put on risk and find the risk. And so we're constantly looking for something, you know, but there are times where I just have like virtually very, very low risk relative to our risk reward.
Gotcha. Stepping back to risk for just a second, do you feel like there is an absence of risk taker in the world? What is the propensity on a societal level for risk taking now versus 50 years ago?
Wow. I would, you know, this is just without a lot of data, but I would just say my observation, my feeling is there's less risk takers and a smaller set of risk takers taking all the pie, right? So the amount of risk that needs to be taken is still there, right? We have big problems to solve, and
not just in trading, but
not just in trading, just in general,
everything.
right? 10 problems, lots of opportunities out there, and there'll be 10 people doing it and one person will survive, right? And I think that the number of problems and the opportunity set has grown, but the number of risk takers has shrunk or remained constant. And so I think that you're having like risk equals reward, right? So you're going to have these smaller subset of people having these giant outside returns, and these people that kind of like quasi made it, cashed out, and a bunch of people that blown up and then they went back into the whatever other field was their backup.
So it kind of creates an asymmetric payout, right? So
Yeah.
the fewer risk takers
Sorry
there
about
are.
that, guys. You know, I'm getting a little jealous of wake surfing. But, this guy's got his boat going. He's gonna.
Oh,
turn
now
up
he's
the
got his music going too.
He's just gonna blast it right there.
Yeah, I always thought we needed some music
background
on the
music,
podcast,
whatever.
So I'm kind of glad this
I'm
happened.
feeling kind of envious right now. Anyway, so.
Yeah, so I mean, the fewer number of risk takers, the fewer people are comfortable with taking risks, the more asymmetric that payout becomes, right? So.
Well, when you look at it, it's like, why are these guys making all the money? It's like, these are the guys taking all the risks. Like, these are the dreamers, right? These are the people that took out the opportunity, and the rest are employees or doing something less risky, and their reward is commensurate with it. And then also, I think when you just dial it back to natural gas, like when investors call, they want to invest. I'm like, you don't want to invest. It's the wild child, right? Are you sure you want to invest? You know what I mean?
Yeah.
You're already rich.
It's not a bond.
Exactly. And once they say, yeah, I want to be in there, you're there, they have the capital allocated. One of the things I say, whether you're investing with me or the other funds out there, the other fundamental traders out there, is that the market will produce outsized returns because the amount of capital that's needed to warehouse all this risk hasn't grown as big as the market. And therefore, what happens is that our theoretical edge, our premium for being induced to put on a trade has grown. So that's great. We should have outsized returns. The flip side is that it's really dangerous because there's not that many other insurance agents go, hey, buddy, I put on some my insurance policy that I put on the spread. It's I got on 40,000 and it's going sideways. Can you let me out? And they're just like, dude, I can't put on 40. You know what I mean? There's not as many
Creates a
people to get you
liquidity
out,
problem.
right? Creates a
Yeah, like we
liquidity
talked
problem,
about.
right? When it's wrong for the entire industry, right? And so those happen far and few between. Most of the time, these guys didn't really want to put on the risk at this level, and these guys put it on at that level, and we kind of are all able to take whatever slice of the insurance market and collectively, maintain an orderly market. But sometimes it's chaotic.
You told me something really interesting the other day, and you said there's only two emotions that traders have, and this is the first time I've ever heard it, but I forget what they were. They were both very negative.
Shame and regret.
Shame and regret. So do you mind unpacking that?
Yeah. So it's kind of a joke. It's like with traders, people always ask me, what makes a trader? Like what is it? Is it intelligence? Is it X, Y, and Z? And I think it's aside from the curiosity, right? I think everybody's smart enough. And the curiosity, it's the stoicism, the ability to handle losses, the ability to have your prefrontal cortex work the same way, despite the fact that you're getting punched in the face or knocked down or whatever in the market. And most people don't have that. But one of the things traders do have whenever they're talking about a trade is shame and regret. It's like, damn it, I fucked up. I'm ashamed that I put on this trade, right? Like it's shame or regret. Damn it, I should have put on more, right? It's like, why did
Even
I
when
put on
you're
more?
winning.
Like
Yeah.
I could have had a yacht. I could have had a boat. I could have did whatever it is, the reward that they wanted, And so we just joke that those are the only two emotions of trading. And it's somewhat true. And so you have to be able to like have a low shame regret quotient, in order to just kind of act like a robot, like in this situation.
And it sounds like that's something innate about the person themselves. So does that mean that not everybody can be a trader, right? There's only a certain subset of people who have that correct.
Well, I think there's like 60% of that's going to be the genetics, and then 40% is going to be like how you were raised, and you can be trained. Like, there's lots of things like the Daily Stoic podcast and Stoic books and how to like detach yourself from results and just be attached to process. And like, this is your job. And I think so some of that can be trained, but I've seen many people, many bright people who just could not be traders, right? It's kind of like, take the most athletic person there is, the biggest, baddest fighter you ever want, and have them go run a 100-mile ultramarathon and then go fight him. Yeah, you're gonna, the little guy's gonna win, right? Like, it's like you just can't compete, right? And so if you're emotionally getting punched in the face, your brain isn't working, right? Like you can't handle it. Like those things should not be bothering you. You know, if you're thinking like, oh, I'm going to be ridiculed, or I won't be able to afford this, or like my kids won't be able to go to school, or whatever, or you know, I could really make this next vacation if I let this trade ride a little bit longer, right?
Yeah.
Like you are now introducing emotions and thought patterns that have nothing to do with the fundamental analysis and what's going on with the market into trading, and you're just dead. You're just dead. And not only are you just dead from like kind of like a getting it right standpoint, you will hate this thing, right? Like I'm agnostic to trading. I only do it because I can do it, and it provides me it affords me the lifestyle that I want, and my other dreams and choices that I want. But I would absolutely loathe it and just be pissed off all the time and angry, and it would affect all my other relationships if I was just kind of like affected by market moves.
Yeah. So it sounds like ego's a component of it.
Yeah.
You have to get your ego out of the trade, right?
Yeah. I'm completely not afraid to look like an idiot. I don't give a shit. Like if I'm lucky and I have a good life, I have 31 years left. I've always known like I have 40 years left. Like I don't give a shit. Nobody's coming to save me. Nobody's coming to help me, right? Like I have a job to do, and if I fall flat on my face, I fall flat on my face.
Yeah. Yeah. So if somebody's in a losing position, right, and they have a big ego, they might hold on to that losing position a little bit longer than they otherwise would have because, I'm just the lone genius in the market, right, who can see whatever the people
There's
don't see.
100 different variations that they will be making decisions not based on what's going on at hand, and whether that's they hold on to a trade, they add to a trade, they do whatever. It's the wrong thing, and eventually a lot of wrong things will crush you, right? Even if it's like a 5% or 1%. Vegas is built on 1% edge, right?
Yeah.
So imagine like you give up 5% or 10% emotional edge where you're just making bad decisions because of emotion. You just over the long run,
It overwhelms everything.
Over the long run, you're just going to get got.
Yeah.
Whether it's personally and you just destroy yourself and your family and it's just not the right place for you to be, or it shows up on your P&L. Probably both.
Yeah. So I'm sure in your experience, you've been in winning positions. You've probably also been in losing positions.
Oh, I've been in some losing. I've been in some losing.
How do you decide that you're in a losing position and it's like, you know what, my thesis was wrong. I need to get out of this and change my strategy. Like, what do you look for? What's your thought process?
Well, trading is interesting because you can have on the right bet, like you made the right trade. Like it's not a guarantee, right? Like
yeah, you got all the fundamentals right, and then the weather came in opposite.
Or whatever. Like it could be, and you could be wrong because of the events. It was a 70% bet, and the 30% came in, and that's the way it be sometimes. Or you could have just
black
been
swan.
Or you could
Freeport blew up.
Or you could just be dead wrong. Like you got the analysis wrong. Like you got the thing where you didn't consider something, you missed something, and you're like, wow, I'm wrong, right? And so that happens all the time. Like think of us as the house in blackjack. People walk away winners all the time. Like, wow, we got destroyed. This big whale came in and took us for $1 million, et cetera. But like over time, by and large, if you stay in the game, you will produce outsized returns. And so one of the cliches of natural gas is the name of the game is to stay in the game, right? Because you're going to get punched in the face, you're going to get knocked down, but you just stay in the game. Just stay with it, right? And so, a lot of people's risk metrics, risk tolerance, situations, et cetera, are to stay in the game. Now, from an investor standpoint, what I would suggest is like allocate to a sense where it's like if you get blasted, like completely, you get a zero in your fund that you can reallocate because you want to be in a space, right? And it can happen. Like it doesn't matter how good your risk metrics are, how the event can happen where you get got. Like
unpredictable events.
There were 2 hurricanes that smashed into St. Thomas, right? Like these things happen in the insurance industry, in Florida, and they got smashed, right? But jet skis. But the insurance business isn't like, well, we just got to get out, right? Like they're like, great, insurance premiums go up next year. They stay in the game and they're crushing it, right? And they decide where they want to be and how they're going to adjust in the future, right? And so, natural gas with that insurance analogy is that we're all glorified insurance agents. It's like the name of the game is to stay in the game.
Yeah, that makes a lot of sense. Changing gears slightly, earlier we were talking about fundamentals versus technical versus algo. You've always been a fundamental trader?
Always.
Have you ever dabbled in anything else?
We look at the technicals because, one thing I learned over time, and I have to give credit for Greg Whaley for saying this to me and kind of beating this in my head, is demand for futures is a fundamental. And so before it was just like, oh, the supply and demand and this and that, whatever in the market. But like demand for futures is a fundamental. And so other people are looking at these technicals. There's, all kinds of shops out there that follow these technicals or trend followers, et cetera. And that is a fundamental that we have to keep track of in order to, have a better entry point, find out what's going on and what that demand for futures is, right? Will be, et cetera. And so it's something that I'm not an expert in. I ask my guys, like, what's going on? And, they're 200 moving day, this kind of pattern, whatever, the algos are buying here. And now there's all kinds of services that track these algos and track momentum traders, et cetera, so we can have kind of a idea on what that fundamental is, right?
Yeah.
And what's going on.
So you think technical trading by itself can be a profitable endeavor? Like there is something going on there that's not, I always looked at it, and again, I'm not a trader, but I was, oh, come on. This is palm reading, right? This is, people are just seeing patterns that aren't there.
Here's the situation. Markets underreact and overreact. I do believe that. And so if there's a trend in human psychology for markets to underreact or overreact, and that's inherent in the price action, then I think that trend following can be profitable. And I think there's enough history out there that has done it. And so these guys that are out there trading, I don't know, hundreds of commodities, right, running these trend following algorithms, right, they're profitable. What am I going to do to argue with them? I tend to think that fundamental analysis and being a fundamental trader in natural gas is a more profitable, more reliable way to make money. But I'm not sitting at that.
And it's
desk.
a clear value proposition
It's
for
clear
society, as we talked about.
How about
before.
this? Insurance firms make money. You know what I mean? Like they do, right? Like, and so like I'm in the insurance business. It's like I think this is a great business to be in, and I think there are outsized returns if you can stay in the game and not get blown up. If I could somehow pull a matrix and download and be an expert in trend following, that would be a great Ginsu sword to have in my tool in order to help my execution on where I get in. And because we're always picking like, oh, at this price, I'll write the insurance policy. I'm like, damn it. Could have wrote the insurance policy at this price, right? So like that would be a great tool to have in my repertoire, and we have some people on the desk that like follow that, and I'll be like, okay, I'll wait a little bit.
Take their advice.
Yeah, take their advice, et cetera.
Do you think that there will ever be an AI trader? Do you think AI will ever take over trading completely, or do humans have some kind of an innate advantage?
Well, I don't think too much about it because I'm an old dog. I'll probably be gone, but I'll be out of the game.
ChatGPT
by that
1.0
time,
just came
trading. I think that the model is only good as its training set and what it's paying attention. And I think it's kind of like VAR, it's looking backwards and I'm looking forwards, right? And so I think in certain areas you could take what happened and look forward and have like kind of foresight. But there's always new things where the market is underappreciating or overappreciating going on, right? Like there's like, oh, AI demand and this and that. And it's like the market might be throwing a little bit of overappreciation for that demand and what that really means for natural gas, right? And certain things may be underappreciated, like, this new facility or this new piece of infrastructure or this new wire coming from, Canada to New York and dropping, a couple gigawatts of power, if that's happening, right? I'm just making things up, right?
Yeah.
Or how this new pipeline is going to change flows. And so I think, I don't know if the AI is going to be as good as understanding the impacts on markets, but maybe.
Yeah, I mean, the AI
Maybe.
might be able to understand what AI demand should be and what, this line is going to mean or that. But there's also a human quality to understand, which is like, do I think everybody else in this market is over or under appreciating each component? And maybe that's the bridge that AI is having a hard time.
I think the area which I will live in or trade in is where AI is a tool that helps us, right? Like I can't wait for the AI to track and keep track of all the outages and outage alerts and alert me to the significance without me going, what the hell is this thing?
Just having a team of analysts on it. You
Yeah,
can replace it with
it's
an AI.
needle in a haystack type stuff right now with tracking outages and like, is this really significant or not? Oh no, they can reroute around here. So like having an AI that knows the outages, tracks them, and goes, okay, this is actually going to result in less supply, or is actually going to get rerouted, or whatever. Like that would be a great tool for me to have. It would free up a lot of neurons, a lot of time, a lot of clerk time.
Yeah.
And so I think the first step in AI is just to help us.
Yeah.
Right? It's not going to replace us. Yeah, it's going to be
It's
great tool.
a very optimistic tool. Instead of, if you're a small hedge fund, right, instead of having a whole team of analysts, a whole deck of people constantly going over these individual outages, you can just have an AI system that handles it for you. And like you said, it leaves you to do higher value things.
Higher value things, higher things like that. Right. Better insurance, more reliable insurance, and hopefully more cost effective for the ultimate end user of that insurance, the market.
Last question about trading. What are the upcoming challenges, particularly for fundamental trading?
I think the biggest problem I had this year, and what I learned, because we're all over like supply and demand, and we're using SynMax with details and drones and thermal and infrared, etc. But I think infrastructure outages, infrastructure delays. Trying to get a handle on that is just kind of like, I think that's been our biggest error rate, right? And one of the things I realized, I was just talking in our shop the other day, I was like, a lot of these pipes were installed in 1950s. The upgrade was 1980, maybe 2000. It's been raining here, not raining here, right? Like, so they're having, how can we get ahead of these? Oh, we stuck a pig in the pipe and we found something and it's going to be down for 3 weeks or 2 weeks, et cetera. Like, I think understanding the infrastructure outages, the infrastructure delays, I think that's one of going to be the biggest things that we need to improve on, because traders are like, oh, blah blah blah, this pipe's coming on in, this is my S&D, and this is our end of season. It's just kind of like, that LNG facility you thought was coming on, it's not coming on when you thought it was coming on. That pipeline that you thought was going to come on when you thought it was coming on, it's not coming on when you're coming on. Or that type of stuff is happening. And so getting those dates right matters probably more than the half a B resolution or B resolution, BCF a day resolution that you have on supply.
Yeah.
Right? It's like you have this massive infrastructure project that's going to ship all this gas out of the country, and your date is moving 6 months at a time. Right, so it's very significant, right? And then you have pipelines from point A to point B that, like, oh, it's down, or this compressor's going to go out. I don't know the average age of compressors. I don't know the how many cycles they're supposed to have before they break. Just kind of understanding that and having an AI on that and probability weight that's something that I want to see.
It's the perfect problem for AI too, because it's both wide and deep.
Yeah.
You have to have a wide understanding of all of the infrastructure components, and you have to go deep into each one. Like you were talking about, this one was built in 1950, right? This one, it looks like they're on schedule. This one, it looks like it's delayed. This one, they're going to have a permit problem, right? It's too many variables for a single human to keep track of. Maybe you could have a whole team of humans, but that's not a luxury that every hedge fund has.
No, and then you throw in probability. It's like these compressors have turbines or electric ones. There's like they blow up or break. They're expected to break, and they have a probability to break after. I'm sure that's a curve on the number of hours they're using, right? And so imagine you had a machine that was like, this is the average break. It knew all the things, and it's like, this is the high probability of breaking in the next 180 days.
Yeah.
Right? That would be really cool, right?
Yeah. And you can start to put numbers around what people would just think of as black swan risks, right? Freeport blew up, this blew up, that blew up, right? Like, there was no way to know in advance. Well, maybe there is a way to start trying to quantify this risk.
Right. Like if I knew, I'm paint an extreme example. Let's say I traded Chicago basis, and let's say there was compressors that put into Chicago City Gate that were there, and it's like, it's been 20 years since they've blown up, and they're 6 months past their blow up date, and they're going to run heavy this winter. I'm like, I'm not going to short Chicago. You know what I mean? I'm going to avoid that one. I'm going to avoid
maybe
writing
don't put a position on, but you at least
I avoid it. I avoid that scenario. I'm just like, because that
on,
thing might just blow up, and then I might have it the other way. It's like, hey, maybe I should put on the basis as like a cheap call.
Yeah.
Right? Because if that
Just
thing
a way
blows
out of
up,
the
it's
money.
going to go ballistic, right? Yeah. So I think that's kind of like how AI could help, and an extreme example of like tracking infrastructure is where I think where the next, where most of our new dollars are going. Our new, gather that information is tracking infrastructure.
Yeah. I agree with you, by the way, about the optimistic case with AI. It seems like the pessimistic case is very simple and easy to make. Well, it's going to take your job. It's going to take everybody's job. Nobody's going to have a job, right? That's a dystopia. That's horrible.
No.
But, when you think about it and you think about AI not as this magical thing, but as just another tool of leverage, right? What have tools of leverage done in the past? They made the world better,
Yeah.
right? They free up our neurons, like you talk about, in order to work on higher value things. And so the only scenario where any type of automation is going to take everybody's jobs is where humans have reached their theoretical limit of what they're able to achieve. And
Right.
I don't think we're anywhere near that, right?
Yeah, I mean, I think the sentience thing is a little bit far out, but I think the very useful tool and clerk for knowledgeable traders is almost is upon us, right? We use it already, and it's starting to pick up tools, et cetera. So I think that is the area. So I think it's going to make us dinosaurs and us new, curious, stoic traders a lot better at where to allocate risk.
Well said. So speaking of trading tools and data sets and automation, you are the president and founder of SynMax,
Yes,
a
I am.
company I personally have great respect for. Why start SynMax?
I think I there's a couple reasons. I use the analogy. I've been digging for gold for quite some time, and I'm a pretty good guy at digging gold. And as part of digging gold, I built a lot of tools, which I'll call shovels, in order to help me dig gold. When I was at Centaurus, I built tools that processes and things to do that. Some pretty cool cutting edge stuff, and I've done that throughout my career. And I'm at a certain point you get tired of digging for gold, right? And I really just want to sell shovels. that was part of it, right? I like every problem is a data fusion problem. Trading is a data fusion problem. There's many data sources. You have to fuse them and analyze them and come that. And I also wanted to attack bigger problems in the world. And so SynMax is a giant Rube Goldberg machine to tackle illegal fishing, right? To make a significant dent in illegal fishing. Now, if I went in and said, hey, I'm going to make this company to tackle illegal fishing and raise money, et cetera, I'm not going to raise any money, and it's going to be very hard to get people to pay for it, right? There's tons of charities and organizations dumping tons of cash into it, et cetera. But in order to do it right, in order to tackle illegal fishing and protect our oceans, which I'm passionate about, you have to have a data fusion. You have to have satellite imagery. You have to know where every single thing is on the ocean at all times, right? And then you can start making strategic and tactical decisions that will have a significant dent. That just so happens to be the same thing to do counter narcotics, tracking military vessels, dark ships, et cetera. It's the same technology for all these other use cases that people will pay for. Great. So now I have this Rube Goldberg machine. I get these customers, et cetera, to help me build and buy the tool and solve all the problems that they want to solve. But I really don't give to that much. I don't really care about counter narcotics. I don't care about stopping rave parties in Europe. I mean, I know a lot of people do, and there are all kinds of people on that side of the debate. I really care about not having our ocean die and ocean health and the global economic impacts that illegal fishing has had on Africa and the world. And so making a significant dent on that is my North Star. And so that's why SynMax exists.
Gotcha. Why did you pick this issue of ocean health in particular? I mean, the world is obviously full of many problems that deserve to be solved. You talked about there's economic impacts, there's the rape of Africa. Why is this the issue that is the most important one in your mind?
It's funny. I was talking to a friend. People say climate change, et cetera, and I said, well, I mean, if you paved over Brazil, you don't change the net oxygen to the world. The oxygen comes from the ocean, from the diatoms, right? Like a lot of people don't know that. They think is Brazil rainforest is where we're getting our oxygen. It's not. The Brazil rainforest uses all the oxygen that it produces, right? And so, quite frankly, if the ocean dies, we all die. Like if it gets 2-3 degrees warmer, will lots of people die? Yeah, maybe. Whatever argument people, have these arguments one way, and I believe them, right? Like I think rapid changes in environment lead to death and destruction and chaos, and chaotic changes always are a problem, right? Like you want orderly change, and so, but the planet doesn't disappear, all life doesn't fall apart, but if the ocean dies, we all die. And so it is the problem. And so if you keep, it's kind of like this Jenga puzzle in the ocean where we're despeciating and polluting and causing all kinds of problems in the ocean, we don't know when we're going to cross that critical boundary and we have ecosystem collapse. And so we've had it happen locally, and that's really bad. And I would like to have it not happen globally, or else we're gone.
Yeah.
Right. And so I think it is the issue. People may debate on how close we are, or do we have to address it, or what the sense of urgency is. But I have a sense of urgency with it, and so that's where I feel that I'm good at data fusion, I'm good at analytics, and I'm pretty good at figuring out what tools need to be built, and being the conductor of building those tools in order to get to an answer and analysis to have an impact. I've been doing it in trading, but it's the same thing. It's just value add on top of information. And so, being delusional that I am, having delusions of grandiosity, I decided to start SynMax to have complete maritime omniscience is what the goal is. And so there is SynMax with its tool, Thea.
Yeah. Your approach sounds very interesting, right? Because obviously there's a lot of charities that work on ocean health and a lot of people that are trying to solve this problem of illegal fishing, but they're all on the 501c3 nonprofit space, right? And it almost makes me think of SpaceX. I don't know if this is your intention or if it's a coincidence, right? But SpaceX, the goal of making human life interplanetary. I don't know how you feel about Elon Musk. He's a controversial figure recently, but he's doing it from a private approach, right? And honestly, he's making a lot more headway than anything else. And I think it's partially because he's taking the massive efficiencies that come from private industry, right? And now he's putting them towards a better goal. And so, would you say SynMax is kind of the same way?
His company, SpaceX is one giant Rube Goldberg machine to go to Mars. Like if you talk to Elon, he pretty much admit that and tell you that. I think they're very clear about that, right? And it's kind of amazing. Like we're gonna redo rocketry and do SpaceX to land rockets backwards and reasonable, make them cheaper. And then we get paid and make a lot of money? No. Then we're going to launch this internet satellite communication service and launch these satellites mass into orbits, and we're going to have internet, and we're going to have this cash flow and have our money. And then we get rich? No. Then we're going to take that money and put it into Starship, and we're going to launch more satellites to make more money. Then we're going to make, no. Then we're going to take Starship and send it to Mars. That's the goal, right? Like it's a giant Rube Goldberg, and mine is pretty much the same thing. It's like we're gonna build this thing or whatever, and then we're gonna track dark oil and sanctions violations, and then we're gonna take the money. No, then we're gonna track the Chinese fleet and military fleets or whatever. Then we're gonna Then we're gonna track subs and add more data infusion. We're gonna track subs from space. Then we're gonna make a money. No, we're going to use our tools and our position of power units or whatever to make a 20% dent in global illegal fishing, a significant dent in illegal fishing. Like that is the giant Rube Goldberg machine. And the same thing with the energy trading side, the energy intelligence side, right? Like it's like all that is driving to make this engine to be in a position to reach the final goal, right? Gotcha. So other people get paid and make money on the way and they get the tool that they want, but I'm building, it's like a gun, right? Like SynMax, the Thea product is a gun, right? And when you hand somebody a gun and you're like, I want you to use it to hunt, or I want you to use it to protect people, but people can use it to shoot people. They can use it for all kinds of different things, right? And so, we have the use cases that we have different customers that use Thea for whatever their maritime omniscience needs are. But my sole use of that tool, what I'm going for is to have this impact on illegal fishing.
So pulling the conversation back to those baby steps towards the big goal, right? Why does the world need Hyperion?
Hyperion. So Hyperion is a tool for traders. So I was building these tools inside of my hedge fund, and I'm a customer of one, and I'd be spending a significant portion of my budget for the chance that this piece of information is the proximate cause or it's the thing. And over time, you have to have it. But it was very expensive for the size of my fund. My fund was like 100 million back then, 120 million, whatever at that time. I would call up other hedge funds and be like, hey, I'm going to build this thing. You want to chop it? I'm buying $1.8 million worth of satellite data to look at X, Y, and Z. I think I'm going to build this tool that gives us a better look at frac crews and rig counts. do you want to chop it? And they'd be like, okay. But even then, it would be too big for my fund. And I was like, why am I having a customer 1 or 2 subsidized? Like, why am I not just putting this out there into the market? Start this engine where I know the products will be great. I know they'll be the best because I use them and I build them. I've been doing this for a while. I know it has product market fit. And then I can use that satellite purchasing power and that data power to build the thing I really want to build, right? The thing where I really have purpose, right?
Yeah.
And so, I think like the customers of a Hyperion are a benefit of my North Star goal, right? As I, have this Rube Goldberg thing spinning up. And I also think like there's a lot of other cool tools and things that like my analysts, like they're you need a whole team to build these tools, right? Like there's a lot of stuff. It's like, hey, it's like there's priorities and priority stacks, right? And so when you have everybody using the tool and lots of customers getting kind of jealous.
He's back.
Getting kind of jealous. And you kind of like paramutualize or socialize these costs, right? Being the customer model, we get better tools.
Yeah.
Right. And we get better analytics. And as I said before, I'm not competing against Mercurier or Morgan Stanley or whatever. I'm just another insurance agent amongst the insurance agents who's writing policy. So insurance agents having better tools to understand the risk is better for everybody, right? Particularly when I get upside down and I need a well-informed insurance agent to bail me out, right? I want them to have a lot of confidence so that they bail me out at a nice price and I don't get boiled, right? And so I didn't see any problem with giving these analytical tools. Rarely am I fighting to get into a trade. It's all you can eat for these trades. The market is massive compared to our AUM, right? You could take the top 5 largest funds and it's just like we're a gnat on a screw of the machine of the natural gas market. And so I was like, okay, we should have the best tools. We should not be guessing. We should be knowing in these areas. This is what I want, and sometimes you just build it yourself.
Yeah. Yeah, and these are big investments, right? And they produce big value. And so on one side, the big investment may be too big for a certain size hedge fund to take on, and also the value may be too big for a certain size hedge fund to unlock. So it only makes sense that it would be decentralized from the system, and you'd have a third-party provider.
How about this? Like I was building tools where the cost, the reward, I couldn't put on enough contracts to get the reward in order to justify it, right?
Yeah.
And so it's like, oh, we need to chop this beast up and let other people, because they can get a piece of reward, they can get a piece of reward, they can get a piece of reward, right? And so since natural gas trading is by and large all you can eat for the trade sides, like you want to go sell X or buy Y, you want to go buy 2 million lots of Cal 25 that the producer's going to sell. Have at it. Like, I'm tapping out at 40,000. That's the max I'm ever going to put on, right? Like at my current AUM, right? When they induce me to put it on, right? Like, it's like, who's got the next one, 1.96 million, right?
Yeah.
So like everybody needs those tools to be like, yeah, this is a great price to warehouse this risk.
And it's not a fixed pie either, right? It's not like, you have to have a loser to have a winner in the market. Like you can actually grow the size of the pie, right? When you have additional intelligence, the market can produce additional value.
There's more demand for policies, insurance policies in my analysis, than there are insurance agents, and therefore the premiums are getting fatter. And you can see that because in certain times of the year, right, everybody's at the tippy top of their VAR, right, with their risk management, because the market is
still an appetite
market
for
is
more.
Demanding more of your balance sheet to warehouse risk, right? That's what happens when prices go very low or go very high or whatever is going on. The spread goes to like, Ocgen went to like, I don't know, this year Ocgen went to the widest. I think the widest it's been as a percentage return ever, right? So the market is demanding more of your balance. They're like, take some more Ocgens. Take some Ocgens. We're really worried about containment here. We're really worried about the winter being super bullish, and we're really worried about containment here. They're like, take some more Ocgens. And so somebody somewhere had to have a lot of Ocgens on their balance sheet relative to normal. And so I think you want, great analytical tools to have the confidence to do that.
Yeah, and it opens up the space. The more of these tools that you can create, the more ability there is for the market of natural gas trading to grow. So We need more traders, it sounds like.
I think we need more capital. I mean, we can use more traders, but we need more capital allocated to this space, right? And we probably need more traders because the way the risk limits work, if you get too much capital, the CFTC in their infinite wisdom and the FERC or whatever have put on these risk limits, basically trying to cap very large shops. And liquidity is volume at a price. And so if you don't have these large shops, you have less liquidity. And so we probably need more shops with the capital, right? So it needs more capital, and then we need them allocated in different shops, right? So that we have that volume at a price, right? Because it's not going to be the small non-reportables who provide liquidity for you, right? They're not going to show up, right? It's going to be the Skylars, the Copperwoods, the Mercuriers, the Whitesides, all the guys, the Citadels, the Morgan Stanleys, the Goldman Sachs of the world, right? Those are going to be the people plus more that I didn't name that are going to provide you the liquidity, right? Not the army of small non-reportables and trend followers, right? And so this market needs a lot more capital.
Last question. I want to take a step back and ask you about this trend that's been going on for the last 20 years or so, right? And that is the proliferation of private intelligence. So, with the advent of the internet, with IoT, with sensors, with satellite images, there's this huge growth in privately, not governmentally controlled intelligence. And that's part of what SynMax is taking advantage of, is the fact that there's so much of this data that we can turn into data intelligence products. So what do you think of that trend as a whole, of the fact that data is becoming largely privatized rather than government owned?
Yeah, so I was having a conversation with somebody who was in the intelligence business, and I showed them a product that we're doing, and we're like, wow, you can do it. Like, you do it better than the government. And internally, the discussion with their contact is that the private market will always do it better. They just don't have access to the data we have, right? So the reason why the government might have better intelligence is that they're allowed to go break into computers. They're allowed to have these high resolution satellites. They're allowed to have these tools, right? Where the private industry, we're not allowed to have these tools. Fast forward to today, where the resolution limit is set now by foreigners, right? If Turkey sends up a satellite that takes images at 10 centimeter, then automatically the rule for us to make our private industry remain competitive is now 10 centimeters. It's a simple form to fill out to, I think, NOAA or whatever the process is. You had launch costs go down with SpaceX, just decimated launch costs, right? So the risk side of putting things up into space has gone down. You had small sat, and so you have this explosion of access, ability. It's now not illegal for you to do this. Things like synthetic aperture radar satellites going up, infrared satellites going up, hyperspectral satellites going up, optical with better resolution, optical with great cadence going on, ad tech with cell phones. All these things now are going into the private domain. Well, guess who's going to do a better job at exploiting those assets? It's going to be the private wizards, right? That's where it's going to be once they get access. And so what we're seeing is an explosion of wizards such as SynMax or other shops, right? Whatever problem they want to tackle. Now, we got access to these assets. Look what we can do now, right? Look, and then they're even more creative, right? Because they have a cost optimization problem, right? They're not the government where it's I'm going to pay whatever it takes, right? We have to do it at a price point that is 10 to 100x below the potential yield for a customer, right? Because the customer is taking that information and analytics, buying it from you, and then going, I can, save or make money based on that those analytics, and that has to be a certain return on that, right? And so I think it's an exciting time for open source intelligence. OSINT, you see me posting that. Some people are like, what the hell is this OSINT? It stands for open source intelligence. You're seeing crazy stuff, right? Even just the hobbyists, right? The hobbyists in Sky-Fi, the other company that I have, right? They are doing some amazing things with the things they care about. People are taking synthetic aperture radar and tracking penguins or seahorses or walruses on ice sheets that they couldn't get to in the dark because they would go away, to have an accurate count of them for environmental concerns, right? You're doing it for tracking frac crews, rig crews, details, et cetera, right? What's going on? You're tracking what type of truck shows up at a site to know where they are in the site. And Vulcan's doing all kinds of things, right? That wasn't possible years ago just because of access to the tech. But once the tech is available, I'm always amazed and astounded. Never go short American ingenuity. Never.
Yeah, I think you're right. Like it's not just the data; it's also the technology, right? So the way the government used to process satellite imagery and aerial imagery, the way they still do to a large part, is buildings and buildings full of imagery analysts, right? And every single photo gets printed out, and they highlight all the important things on it, and it goes up this giant chain, right, to hopefully filter it down into an intelligence answer. And now we have AI, and we have all of these data tools, and we have the data coming at the same time. And the private market, like you said, is they're going to have a cost optimization. And they're finding ways to do these same things and get the same answers or better answers, right, with a fraction of the cost and the fraction of the investment.
I would argue better. Like I see some of the wizardry we do in THEA, the Maritime Intelligence Project, and it's just like the next iteration in the next week is always like another level of wizardry, right? And I think like providing access to this, like some of this imagery that was like not necessarily the best quality imagery, right? We're like, don't worry about it. We got you. You know what I mean? We're gonna extract value out of assets. Just let us get these wizards and these hobbyists and just a general world. Like nobody beats the crowd, right? Let them get their hands on it, and they are going to do amazing things with it, right? Like and it's always the case. Like you ever just see like you go on the internet and Instagram, like how did a guy make this out of paper and so and so? Like all these creative people. It's the same way in tech field and AI. Right, like how do you extract a signal out of that imagery? Like how did you do X, Y, and Z? Right, it just never stops. And so I think, my hope is that as the hardware, the AI, the fusion of all these tools, right, will solve some of the world's greatest problems. And I think one of the greatest problems or greatest threats is illegal fishing, and that's the Rube Goldberg machine that you are in, sir.
That's right.